I can't believe it. Can you believe it? We're almost here, like almost to a Friday. But guess what though?
What's up?
We're live.
Yo!
I got you. I got you.
Oh, actually, it was people that got me. Sorry, guys. I'm sorry. I was totally taken aback just a moment ago. So,
how are you doing today? How are you?
Yo. That's all I can say is yo.
Okay. All right. So the vibes is mutual here. We're ready to get it today. You know, there's no gloves today over here. So like I'm in full workout attire. I've been like, you know, like getting my reps in and everything else for today.
Okay.
It's gonna happen. So, but you doing all right?
I'm good. Mm-hmm.
All right. Yo, what's good, everybody? I'm Mark Monroe, and I am accompanied by my wonderful co-host, co-producer, co-creator, and good friend, the wonderful
Jolene GC. Don't play with me.
Okay. All right. That's what I'm talking about. And this is not Hot Take Thursday. This is actually the Cookout Part 2. And we're actually going to be here on the stage with some wonderful, phenomenal people in whom which that are going to talk real with us. Because I feel like, you know, we've had some wonderful cookouts, but I think it's now time for us to actually start getting a little bit more real with the people. And so who better than some of our guests today? And some of them, I think you may know who they are. I think it's no surprise, but we're going to hold off a little bit on that real quick. But Jolene,
what's up?
I don't know if you know who the first person is today, but I just want to send a special shout out to Jalen Graham for being the first person in the live chat. So what's up, Jalen?
How you doing?
And if you haven't subscribed yet, go ahead and hit the subscribe button down below. If you like the video, go ahead and hit it so that way other folks can be recognized and they can see this video. And then we probably bring in more cousins and they can check out this awesome content and learn just as much as you're learning in the process. And if you want to be in the know, or if you want to be a part of the notification squad, go ahead and hit that bell so that way you can be a part of the Cool Kids Club. Now we got that out the way.
Yeah.
Jolene.
What's up? Yo.
Jolene.
Yeah. What's up?
I need a vibe.
Oh, I should have lit the candles. Oh well, you got me with that. But yo, if you're gonna share, make sure you share with cousins that are gonna do some thinking. Who think? We're not spoon feeding. We're at the cookout. We got plates, but you kind of got to make your own plate if you know what I mean.
Indeed.
So let's get into this market. All right, what's up, everyone? My name is Jolene GC, and the place to be, aka Don't Play With Me. And it's not Hot Take Thursday. This is F What You Heard Thursday. No, I'm just kidding. We got the Dow coming in at negative 23.34 points. The S&P 500 is negative 15.27 points. We got the NASDAQ at negative 141.82 points. The VIX went up a little bit since the last time we saw you to 18.04. And the 10-year Treasury note is coming in at 1.62%. Now for sector performance, as you know, there are 11 sectors, and we track the top 3 and the bottom 3 so we can see what the rotation is looking like. We got utilities, consumer staples, and health coming in at number 1. And then coming in at the bottom, all red, communication services, technology, and consumer discretionary. Now for pick performance, as you know, you can find all of our picks, aka the Sept, at our on our IG page at That Come Up series. We have NVIDIA coming in at number 1 with the 52-week high, TBT, and then we also have TGT, aka Target, coming in at a 52-week high. And then for the bottoms, we got Tesla, C-Web, and Twilio. So that's the market. Now, as you know, we need to set it off with, this is not even history. This is like present day, but it's rooted in what's happened in history and what continues to happen today. And this is from the book, How to Be an Anti-Racist by Ibram X. Kendi. If you don't have that book, it's actually a good book. It offers a different perspective on if you were looking at things in a new paradigm. If you don't read the book like that, you will be irritated the whole time you're reading it. So think of it as you're reading it, you're in a new paradigm that Brother Kendi is trying to paint for you. So how to be an anti-racist is part How to and part memoir. Author Ibram X. Kendi, like many of us, grew up in a racist society and internalized many of its ideas. Throughout much of his life, he was racist. I'm going to put that in quotes. In How to Be an Anti-Racist, he describes how he changed his thoughts and actions and how you can change yours to become anti-racist. This author takes readers through his journey to become an anti-racist, a person who believes that all racial groups are equal and supports policies that reduce inequities. Anti-racist acknowledge that there are differences between races, but these differences aren't responsible for inequities. Policies are. So How to Be an Anti-Racist covers 3 major steps to becoming anti-racist. 1, learn what racism is and how it evolved. 2, become aware of the subtle racist ideas you might have been unknowingly supporting and weaken them. And 3, start supporting anti-racist rather than racist policies. Here is a notable excerpt. In the liberal haze of racial progress, some well-meaning Americans started consciously and perhaps unconsciously looking for other terms to identify racism. The term microaggression became part of a whole vocabulary of old and new words like cultural wars and stereotype and implicit bias that made it easier to talk about or around the R word, aka racism. That is in chapter 4, the chapter about biology. So yeah, if you want to read that book on a different perspective, then go for it. Hit me up. We could talk a little bit about it if you're up to it. So Mark, what's good?
We had a great cookout and that was super duper dope, but we kind of got interrupted on that episode where we were just starting to open up and get real with the people. And then of course we had a librarian, Linda, that stopped the whole show because I guess there was a whole shutdown situation.
She was through the window. She was like, yeah,
like it was like on some Stomp the Yard, who's that creeping in my window vibe. So I feel like it was time that we essentially run that part 2. We need that part 2 like ASAP. So I mean, if you watched the cookout with Mr. Anthony Chukumba, then you knew it was amazing. And today we're actually going to have that part 2. And, let's just let this brother up in the room. Anthony Chukumba, can you please come to the stage? Welcome. But before we get started, how are you today?
I'm really good. I am so honored to be back here for part 2. I'm really hoping this is like the Godfather part 2 and not Wall Street part 2, Money Never Sleeps. Okay, I'm hoping that this is a nice sequel here.
Okay.
But listen right now. Before we get started, I've been doing a lot of soul searching. I've been doing a lot of thinking since my last appearance, and there's okay, Anthony, hold on, Anthony. Okay, sorry. I prepared this apology that I need to read, and I'm praying that you can all bear with me so I can get through this. This is very emotional for me. In my misguided quest to speak my truth and keep it real, the last time I was on your show, I offended a number of people. I don't know if I was influenced by the max blackness of the episode. I don't know if it was Mark Monroe's sunglasses. I'm not sure. But ultimately, it was my responsibility, and it lies on me and me alone. I am very sorry for the hurt that my words during my last appearance caused to many people, including GameStop chairman Ryan Cohen, dog lovers, GameStop management, GameStop shareholders, the medical profession, cancer patients, men who suffer from erectile dysfunction, Keith Gill, aka Roaring Kitty, the residents of Roaring Kitty's hometown of Brockton, Massachusetts, and last but not least, people that are currently broke because they purchased GameStop stock through the Robinhood app on margin. I have learned from my mistakes, and I assure you they will make me a better person. On that note, I would no longer like to be preferred as the keeping it real cousin, but going forward, I would like to be called the keeping it kind cousin. So with that, I have one more thing to say. Psych! Okay, I'm keeping it real. Come on. Bring it, come on.
Let's go. All right, that's what I'm talking about. We need that energy tonight. Yo.
Yes.
Yeah, so we just throw all that out the window. But before we do that, I feel like we definitely need to like open the door just a little bit wider, and that's what I'm talking about. We got Big Cousin New York in the building.
Okay.
we got a new segment, the Run Up Cousins, is coming in summer. We're gonna launch on the Come Up Series page, the Run Up Cousins we hear. It's gonna be a lot of YouTube apologies out here, whether it's stocks apologists or just real life things. It's coming soon to you guys soon. Produced, directed, and cameraman by me.
That's what I'm talking about. Yo, just make sure that you find the lead singer of the Carl Thomas the Carl Thomas song.
Yeah, for the rest of this, I'm gonna be the check-in cousin. I'm making people check in now.
All right. So y'all ready to get started? Y'all ready to get into it?
Yeah.
Okay. I know that I'm clapping because I'm like just so amped right now. So like, just bear with me because there's a lot that's been going on. All right. So Anthony.
Yes.
Please tell me what the heck is going on as it pertains to GameStop, AMC, all these meme stocks. Let's just keep it 100, please. Can we just start off with just keeping it straight up 100?
Sure, absolutely. I mean, this is deja vu all over again. It's really quite unbelievable to me. I mean, obviously, we've seen the volatility in these meme stocks, whether it's GameStop, whether it's AMC, whether it's BlackBerry. It's just insane. It really, really is. And I don't know exactly what the impetus was for round two. I'm not, I think it's a lot of those same factors that we saw before, with these individual investors on, these Reddit boards, the most notable one being Wall Street Bets. And once again, I don't know how long it can continue. I'm reminded of famous words: the market can remain irrational longer than you can remain solvent. But I have a couple of thoughts. First off, let's be very clear, okay? If you are investing in these meme stocks, GameStop, AMC, BlackBerry, so forth and so on, you're not investing, you're gambling. And if you want to gamble, go to the casino. At least there you get free drinks. It's not investing, okay? It's just not. It's really, really not. Don't get me wrong. I'm sure there are selected people that are making money in these stocks. But at the end of the day, I'm reminded of the words of one of my financial advisors. The only people who consistently call market tops and bottoms are liars, okay? So if you made money, good for you. But you got lucky. Don't conflate luck with skill. And if you made money, take the money and run, okay? Run. The other thing is, we have to remember, there are thousands upon thousands upon thousands of stocks out there. You don't need to be involved with these meme stocks. You really don't. You don't have to have a position one way or the other. You can just punt. And quite frankly, I mean, look, as we all know, I no longer cover GameStop. I'm not going to spend a bunch of time on this talking about GameStop or any more than I need to. I think I've beat that dead horse, over and over and over again. But at the end of the day, like, look, I cover Bed Bath & Beyond. I have a hold rating on the stock. Yesterday, the stock was up over 60%. It was inexplicable, absolutely positively inexplicable. But what did I do? Did I upgrade it? Did I downgrade it? I just said, you know what? It's going to do what it's going to do. I don't have to make a call. Hands off. Exactly. Hands off. And so, look, and I want to be really clear about this because, look, I've gotten it on social media. I'm a boomer. I'm this, I'm that. Everyone's sure that I'm either A, short GameStop stock, which I'm not, B, in some sort of, conspiracy theory with these big hedge funds. Once again, not true. I don't have a horse in the game and in the race. I really, really don't. But, your show, what you guys are doing, it's about closing this wealth gap, in a generation. And I'm telling you, you're not going to close it, by trying to time meme stocks. That's not investing, it's gambling. So I just want to be very, very clear about that.
Okay. So because I know that there's going to be people in the chat that are talking about, well, hey, I'm making a ton of money off of GameStop or by AMC, literally just AMC going up 100%. like in one day. Can we talk about like, can we just talk about like the realness here, like about stocks going up 100%? Like, like,
I mean, look.
does it like
Mark, look, I have been doing.
I'm slightly at a loss of words because what I really want to say versus what I want to say are two totally different things.
Absolutely.
So I'm going to go off of what I really want to say.
Sure.
So here's the part, Anthony. At what point in time where it's just like for those in which that are trading these stocks, or that are like whether you're trading it on option or they're trading it on, or they bought the stock. At what point in time should they literally be saying to themselves, okay, like what should that mindset process look like when it comes to, hey, all right, I got like really, really lucky. What should be the very next thing that they're thinking?
I'm going to exit this position as soon as possible. I mean, look, I'm reminded of the words of Kenny Rogers, the gambler. You got to know when to hold them. You got to know when to fold them. Got to know when to walk away. You got to know when to run. You never count your money when you're sitting at the table. There'll be time enough for counting when the dealing's done. I mean, look, once again, don't conflate luck with skill, and don't gamble. Like that's not how you create wealth. You create, and look, I'm not saying, okay, you have to go out and buy mutual funds. You have to go out and buy ETFs. I'm not saying that at all. If you want to do research on stocks and you think that you have an edge because of the work that you've done, like go for it. Go for it. And I'm not even saying like, oh, don't ever go on, Wall Street Bets and get ideas. I mean, that's perfectly fine. But stocks trading up and down 20, 30, 50, 100% in a day, like I've been doing this a long time. It's not normal. It's really, really not. And once again, the only way you're going to consistently make money is if you're going to consistently time those stocks correctly. And it's really, really hard to do. Like I said, Bed Bath & Beyond was up over 60% yesterday. Well, it was down like over 20% today. So, it's like, I'm sure, look, you'll go on Twitter and you'll see or Wall Street Bets, you can see all these people, hey, look at me, rocket hands or, whatever, to the moon, I made all this money, I bet you're not going to hear that many people who bought it, at the open today and got their faces ripped off today. So, it's I'm just trying to keep it real. Okay. I'm not trying to be a boomer. I'm not trying to rain on everybody's parade. I'm just keeping it real.
Q, I definitely got to ask you, like, what is it that, like, because we're getting ready to move into the retail investor versus the institutional investor. Mm-hmm. Like, what's missing here? Like, because obviously there's a lot that we're seeing on both sides. We're seeing on one side that we're seeing that, okay, hey, the narrative, like walk people, like I think a lot of folks, especially cousins, maybe some of them don't even know the narrative. So could you possibly walk us through that process of like, just helping folks come up to speed? And of course, feel free to add your sauce to it as well.
Oh, no, my man's over here giving out gems. So I'm reminded of the urban philosopher ESTG. Once said on a song, I can't say I had a 10-year run without no hiccups. And I say that to say is that when you're in the market, you're in it for longevity. And so what we're seeing is a lot of thematic investing on both sides, right? The last 18 months has been something that we've never seen before in the market. These are uncharted waters for us. We haven't had any historicals to tell us things, right? And on top of that, when you start looking at economic data, the market doesn't believe it. The Fed is learning on the fly as we kind of sort through some of these issues. So there's a lot of planes that have to land. I think retail investors came into the year smelling themselves, had a great 2020, right? Everybody made money from March to the rest of the year, and they became Warren Buffett. They became George Soros. They're buying houses in Malibu. And the market came in this year and corrected on everybody, whether it was institutions or whether it was retail investors. So both sides are feeling it. And I think that when you start looking at the meme stocks, some of it is the institutions trying to get the money back they lost by manipulating prices and getting people to buy into a fairy tale. When we were kids, your parents would come in your room, They would tell you a story, a fairy tale, and they'll put you to sleep. And you'll wake up the next morning, right? And we went through this, Mark. When you wake up in the middle of the night, that pile of clothes looks like a monster. You run in your parents' room and say, Mom, there's a monster in my room. And in the morning, it's a pile of clothes, right? And so I think that's a great analogy for the market. For the market right now, everybody sees a monster, right? But the real investors see a pile of clothes, because we understand that some of these inflation fears are transitory, right? I can take advantage of that. Because if I made money in Square from 55 to 200, why wouldn't I take my money and go to value stocks when the market shows trepidation? Why wouldn't I take my run up and go to industrials, financials, materials, things that are low PE ratio stocks that may not have the higher upside, but they trade on fundamentals. I understand how they trade. So when I look at that as an institutional investor and I see retail investors smelling themselves and saying, oh, I'm the greatest ever, I'm this, that, and the third, I'm looking for a way to say F you, right? And so you have that buildup. So I think that when it comes down to the market right now, you have a lot of planes that have to land, a lot of misinformation, and more than anything on both sides, a lot of ego trading, a lot of I'm so-and-so or I'm this fund, and you get caught in the headwind. And Anthony made a good point. You don't have to partake in that. And I tweeted out the other day, I said, yo, you'll learn as an investor that you don't have to partake in every uptrend. It's much more peaceful on this side. And I say that to say is that I invest in what I invest in. I'm not worried about what you're doing. The one greatest thing about Jay-Z is Jay-Z runs his own race. He's not worried about what Kanye is doing. He's not worried about what Drake is doing. He's worried about what Jay-Z is doing. And he's very successful at doing that. And I take that lesson as an investor. I'm not worried about what Anthony's invested in. I'm not worried about what Mark's invested in. I am worried about what makes sense to Quentin and what makes sense to me in my portfolio, right? And institutions do the same thing. I'll give you a good example. Everybody loves Tesla, right? Everybody loves Tesla. We all can say Tesla's a great company. We love Tesla. Okay, but there's still momentum and run up in GM and Ford. So institutions are going to look to take advantage of that momentum, right? They've had great investor days. They're releasing new products. There's sentiment. And sometimes, right, and this happens in real life, sometimes the story is more interesting than the actual facts, right? Sometimes the gossip is juicier than what happened. So when you come to school and I say, yo, you heard so-and-so got into a fight, he snuffed him. And it wasn't even like that, but the story sounded better than the altercation. And so I think we're getting that. You go on CNBC sometimes, and sometimes the headline is more interesting than what's really happening in the names and what's going on. Retail investors cannot be so trigger happy, right? And institutions have to stop being so emotional and have to realize that retail investors have gotten smarter. It's the big brother, little brother theory. If you were my big brother and I grew 5 inches in summer, well, guess what? Now the fight's a little more even. And what we have now is a smarter retail investor with a cocky institutional investor, and it's starting to balance itself out. So I think on both sides, there is a lot of improvement needed. And I think that we have economic problems. Like I said, the Fed's learning on the fly. So over the last year, right, if you think about households have been deleveraging. And so you have a deleveraging household, which gives you what? It gives you more capital, but it doesn't mean that people have to spend that capital. So now when we start to talk about inflation fears, we start to talk about rates and yields, right? We start looking for discounted cash flows in the future. Well, I have to discount that cash flow a little bit more because there's question marks there. And the market doesn't believe what the Fed is saying, right? And so that disconnect causes these big swings in the market. And then everybody's right. I'm right on Monday. You're right on Tuesday. Anthony's right on Wednesday. Jolene's right on Thursday. Right? There's no synergy to what's going on. And so when you don't have synergy, the market hates that, and it creates an even more uproar. So now you have, again, institutions going, we're losing money, right? Hedge funds, we have to make our watermark. Now let's touch on hedge funds real quick. Hedge funds don't have to pay taxes. Why? Because all of their management company stuff is offshore, Cayman Islands. Maybe it's in Geneva, right? Places where you can't see their financials. So they cause the most chaos and pay the least. So when you look at like having to raise wages and say, okay, we're going to raise wages and we're going to make Amazon and Walmart and Target and all these retailers, McDonald's,
I think it's 15%. Yeah.
More, right? Pay their employees more. And then that inflation gets sprinkled to the regular retail investor and to the actual consumer. They're pissed, like, yo, we're not even causing this issue. It's hedge funds. They're not even paying taxes, and they're making this big swarm of money. So you have multiple almost wars going on, whether it is at a higher peak or a precipice, and then at a lower peak and precipice. So I think that people need to understand that you have to pick and choose what battle you want to fight. I can't fight every battle. I can't fight the AMC battle. I can't go fight the GME battle. I can't go fight the Apple battle. I have to pick what battle means more to me, right? And protect what means to me. As an investor, when you learn this, what DMX said, mind your business, lady. When he's right, stop being nosy. Mind your business. If it's not for you, mind your business. Go about over here. Don't worry about what's going on over there. The quicker investors learn that, the better their portfolio will look, the less positions that you have that are worthless, and you'll be able to hone in more on companies. And that I'll go more into that because I actually have a little bit of a lesson I want to go through with guys later on because I think it's really important to show.
Okay.
I have a question.
All right.
So, y'all, all of this, and on an intellectual level, it all makes sense. My question is on behalf of the cousins. So the cousins in my DMs and in various places, they're hurting right now. And so their thing is, well, if you're new to wealth building, you don't have the longevity mindset yet. You just don't. Like, you get it on an intellectual level, but you don't get it. Like, it's not in your bones. It's not in generations yet. So how are they supposed to take this information in and then actually apply it? Because right now their portfolios are giving off hella like desperation vibes. And so the AMCs and the GameStops and whatever else, all the meme stocks are giving off like, quick and easy. And the mindset's not matching up. So my concern is, how do you corral that type of mentality so that you can stay in it and mind your business, and also at the same time, like, look towards the future? Because there's a gap right now. I see this happening over here. All these people are making money. I'm trying to make money as well, and there's multiple gaps and different layers. There's the gap in not having money in the first place. There's the gap in thinking that, I'm investing this money, and let's be real, there are a lot of cousins out there that have invested money that they can't afford to lose, but they did it anyway. Yep. And so what are they supposed to do? Like, what mindset are they supposed to have? Because it's easy to say, mind your business. That makes all the sense in the world. But I'm thinking, like, on a practical level, what are they supposed to do?
Yeah, let me tackle that.
Let's do it.
I mean, a couple of things that you really need to kind of think about as an investor. First off, investing is a marathon. It's not a sprint, right? I mean, and there are no get rich quick schemes out there. There really aren't. Right? I mean, yeah, are there people out there like Roaring Kitty who made all this money in GameStop? Yeah, there are, but there are also a lot of people who lost a ton of money in GameStop, right? So you can't have this FOMO. You can't have this fear of missing out. And by the way, and I hate to say this, but you really shouldn't be investing money that you're going to need anytime soon, right? Because once again, then you're trying to time the market, right? So in other words, if I've got, I'm just making up a number. I have $10,000 in my portfolio, right? But I know like 5,000 of that I'm going to need in the very near future because I'm going to, put a down payment on a car or put a down payment on a house or whatever the case may be. Okay, don't put that $5,000 in the stock market, right? Like, it's just not a smart idea, because it just may happen that when it comes time to put that down payment on the car, put that down payment on the house, the market might be down, your portfolio might be down. And suddenly you're like, okay, that $5,000 is now $3,600, whatever the number is, but I need it now, right? So you have to take that loss, as opposed to, okay, you know what, this other $5,000, this is for my retirement, right? Or this is for, the house that I'm hoping to, buy 10 years from now, right? Because if you look over almost any long period of time, the market almost always goes up over long periods of time, right? There's going to be volatility, but generally it goes up. So you just don't want to try to time the market, and you can't worry about missing out, because there's a lot of people who are losing money as well, and you don't want to be one of them. I'm reminded. So I have a very good colleague, and he's a guy who's been on Wall Street for a long time, very, very successful for a long time, but he never really invests in the stock market. And believe it or not, that's not terribly uncommon. I have another good friend, once again, been on the market as long as I have and never really invested in the stock market. He's worked on the stock market his entire career. He's just conservative, right? So, so this buddy of mine, he's married, he's got a child. And he decides, you know what, I really should start investing in the stock market. And I set him up with one of my financial advisors here in Chicago. And, this guy's got him all set up and took, got a chunk of his money invested in the stock market. Okay. And this was early 2020. So then the pandemic hits, right? March 2020. The market falls off of a cliff. Falls off of a cliff. And he comes to me and says, I'm really nervous about what's going on in the market. Like, what are you doing with your portfolio? Like, should I basically liquidate my portfolio so I go to cash now? And I looked at him like he had two heads. I was just like, are you insane? I was just like, the market's like way down. Like, you're going to lock in those losses. And, and this is money that, you're not planning to use this money anytime soon, right? I mean, this is like retirement money, right? And he's like, yeah. I'm like, so then don't even think about selling. Don't even think about selling. And look where the market is now versus where it was, early in late March of 2020. It's up huge, right? And literally, I had a conversation with the same guy a few weeks ago, and he's like, thank you so much for basically, talking me off the cliff. So I wish I could give the cousins, better advice. And here's how you can double your money in a couple of weeks or whatever. But that's not realistic, quite frankly. It's just not. It's not the way you want to invest with a portfolio. I mean, you want to, really have a long-term investment horizon, and you want to invest, money that you're not going to need anytime soon. The other thing that I would tell all the cousins is, look, the way to invest is to invest a little bit at a time, whenever you can. So, for example, through your IRA, right? So every year you put together, I can't remember the exact limit. It's like, I want to say it's like $2,000, $6,000, right? Right. Or if you're fortunate enough to work at a company that has a 401k, absolutely take that, have that money come out of your check every paycheck and go into your 401k. If you're really lucky, your company will have a match, and they will match part of your contribution, right? And that, once again, like, that's money that you're not going to touch, and it's going to grow over time because it's going to be constantly invested into the stock market. And that's, I mean, honestly, that's how you build wealth. I mean, there are no shortcuts.
So I guess the question is in the sense of, because what happens when, and I think this is the part where I think that it's hitting the point for Jolene and myself and probably many of the other folks, like, what happens when essentially your thesis reads one thing over the long-term stretch, but then you're going through this in the current. So like when you were talking to your friend, when he saw that the pandemic had just hit, how is it that, how does one get over that type of mindset where it's just like, oh, Mississippi is burning, to now it's like, all right, but I got to think further down the road? How does one channel that?
No, I think the only way that you can really sort of channel that and get comfortable with that is learning a little bit about the history of the stock market. And I'm saying a little bit. I'm not saying you have to go in and read, Warren Buffett.
Since the beginning of when Andrew Jackson started.
Right, exactly. And, Benjamin Graham's, value investing. I mean, you don't. I mean, but if you look at, like, literally just look at, 20-year, 30-year, 40-year charts of the major indices, and you will see, like, they sort of go like this, but they're generally going up.
Going up, right? In upward trajectory.
Going up. And so, you just have to be comfortable because, look, when you really think about it, right, the stock market over long periods of time, it's a proxy for GDP, right? Over long periods of time. I'm sort of oversimplifying, but I think that there's truth to that, right? And GDP, I mean, the population is pretty much always increases, right? And as the population increases, then GDP generally increases, right? Particularly when, you live in the United States, you have a very accommodative government that can just print money, right? And always has an incentive to keep people happy. And so, look, in general, stocks are going to go up. There are going to be volatile periods, and you just have to be willing to to basically sit out the volatility. I mean, look, I have a large amount of money invested in the stock market. I mean, I've been, obviously I'm a lot older than all of you guys. Okay. I'm not going to say how I'm 49. We're not going to talk about how old I am, but I'm older than you. And, look, I, and I have a few different, whatever, brokerage accounts, whatever, I rarely ever like go onto my phone and punch up my brokerage account and see, how much money I have in my account. I really don't. And I work in the stock market, right? Because and the reason I don't is like, what good is that going to do me, right? I mean, it's like, well, if it's a good number, okay, well, I'm not gonna, take profits, right? I mean, I have this invested for the long term for my retirement, right? For my kids' college savings plans. And if it's a bad number, once again, like I'm not going to cut bait, right? So it's like, it's like I was listening to a podcast the other day and somebody was talking about, oh yeah, like I check my account several times a day. And I'm thinking to myself, why? It just didn't make a whole heck of a lot of sense. So you just really have to be patient. And I know that's hard, but
it's a lot easier said than done.
Understood. That's a very fair point, Mr. Monroe.
So let's talk about like the road ahead. Because we're now at the 6-month marker. Here we are in the year. And we're kind of like going through this whole choppiness within the market again. And now it's just like, all right, well, what should investors be thinking about like the next 6 months, or if they're preparing for the next 6 months or for the next year, the next 2 years? How is it that they should be like channeling their focus? Like, because really the past 6 months, it's happened, it's over. How should one be thinking now? And I think I'm going to leave that for both you and Q, just as a heads up.
Yeah. Let me kick it off. I mean, look, I'm feeling really good about the next 6 months, right? I mean, when you really think about it at a high macro level, right? Vaccinations are going up, right? More and more people are getting vaccinated. COVID-19 infections, hospitalizations, deaths are all going down. The economy is reopening. We have, wage growth, right? I mean, there are a lot of people, who are just saying, I'm not going to work for $10 an hour. Like I want $12 an hour. I want $15 an hour, right? And you definitely see sort of a supply demand imbalance in terms of wages. And that's really, really good. In addition to that, we still have some lingering impact from the $1,400 checks, that came out in March, April. You do have, the enhanced unemployment benefits, the extra $300 a week. Those are going to run through September, aside from, states where the governments are pulling back on them, but I don't want to turn this into a political conversation. I'm not going to tell you who I voted for in 2020, Biden, but it's neither here nor there. But the other thing, and I've actually been doing a lot of work on this and a lot of thinking about this.
Okay.
You also have this expanded child tax credit that was part of the American Rescue Plan. And let me just spend a little bit of time on that. So basically, the way it works is previously there was a child tax credit that was about $2,000 for every child you had under 16 years or under. But what happened, the way it worked is you would wait until it was time to file your taxes, and then you would be able to take this tax credit, right? And ostensibly you'd get a bigger refund, or you'd owe less taxes because of it. Well, under the changes to the tax credit, basically what they did is they said that $2,000, it's now $3,000 for children from the age of 6 to 17. So they actually brought it up 1 year. Okay. And in addition to that, it's $3,600 for children under the age of 6. Okay. As importantly, if not more importantly, they said, okay, you don't have to wait to file your taxes. The government is literally going to be sending people checks. People are going to get checks in the mail, okay, wow, based on the number of kids that they have. And so that is more money that's going to be coming into the economy. First off, it's wonderful. I mean, projections are that it's going to lower child poverty by like 50%. So that's amazing. But it's also going to be, a tailwind. It's going to be more money that's going to be going into consumers' pockets. And so I feel like that's really going to also help economic growth in the back half of this year. It's going to be the economy reopening. It's going to be this child tax credit. We'll see if we get an infrastructure plan. That would certainly be a positive. And that's, it looks like there's a lot of wrangling going back and forth in Washington on that. But from my perspective, all systems are go. It's a great backdrop. Now, obviously, like any other time, you sort of, you want to kind of pick your bets and think about who that's going to be good for and maybe who that's going to be bad for and make your sort of stock picks accordingly. But overall, I think it's a pretty good backdrop for stocks.
Okay. Q, what you think, brother?
I'm going to agree with Anthony, but I will say I think the one thing retail investors have that institutions don't have, again, I always say, is time, right? And you got to be prepared with the time that you have. And so, yeah, we have a lot of tailwinds coming in as far as money, right? But what does that mean on the other side, right? Do wage increases outpace price increases, right? That's the thing. That's the thematic that could happen, right? Not saying it's going to happen, but let's put it on the front of our brains in terms of what happens. What does our first winter look like post-COVID, right? Like, how does that look in cold and flu season? How does that affect immune systems that haven't been tested in the last year? When the weather gets cold and people kind of get back to normal and things of that nature. Not that these things are going to happen, but I think that the mistake that we've made time over time is being too prosperous and too euphoric. And so we're not prepared for when things kind of get a little bit shaky to take advantage of that. So I think moving forward, right, we have an infrastructure deal. The infrastructure deal gives me a lot of hope because the one thing they're giving on is taxes, right? We're looking at the tax rate and looking at Biden saying, hey, I may push this back to a flat floor, 15% and some other things, right? So it gives me a lot of hope that we get a deal done, which gives more money. Anthony brought up the child credit tax. I think that, again, wage increases, right? But how does that affect future pricing? Does that outpace at some point in time and create a ripple effect maybe in the fall when things get going? I don't know, but I think that we're headed toward better times moving forward. I think that as a market, we're gonna start to figure out what data is real, what data is not real. Now, with the jobs, it's hard to tell with job data what's real, what's not real. People are voluntarily sent out the game. So how can we use that economic data to get any information on what's going to happen in the future, right? And that kind of creates other thematic things, whether it's in housing or materials. So when you think about people are fixing their homes, the price of wood, the price of copper, the price of steel, those things going up, but people are still building. Why? Because they have extra money. So how long does that take before the building stops or the home building stops, right? Does that affect numbers? Some numbers in April are a little bit lower. So now I'm keeping my eye out on what does June, July, August look like as far as home building and those material numbers, right? To get a better idea from an economic standpoint where we're headed. And if the data starts to validate, I think that's the one thing you always say, Mark, right? The data has to validate. And I think a lot of times in the market, our opinion cannot validate, right? My opinion of Square, and shout out to my man Zay, I talk to Zay all the time. My opinion of Square, I'm gonna tip my hat, right? Don't have nothing to do with Goldman outperforming. That's my guy. Me and him argue all the time. Goldman's outperformed. My opinion of Square doesn't matter. The market has told me what matters to them. They have told me what data matters, what economic data, right? That stock has went from 185 to 390, right, in less than a year. And they're telling me what matters: SPAC deals, IPO, yield, inflation, right? Stock buybacks. They're telling me. So I would be wrong, right, if I continue to trade on my own opinion and not the economic data. So I think moving forward, we have to look and say, okay, what is ahead of us? We know that prosperous times are coming. We know that people have more money. We know that things are opening up. We're going to be traveling more, different things. But what are the risks behind that? What possibly could happen where things go the other way? So again, I'm big on portfolio management, really big on that, right? How is my portfolio managed? What kind of liquidity do I have? Where am I invested, right? How can I take advantage of that? If I am in options, right, how can I play that? Do I buy some shares when the market's trading sideways as opposed to buying more options contracts way down? Maybe you're comfortable in that position. Maybe you say, hey, I want to buy some shares and build a base there because I'm comfortable in the name and I really appreciate what management's doing, what the future holds, right? I think when we start to look at those things, that's what the future holds for us. We have to figure out what the market is going to do in the future, right? Because all we're doing as investors is underwriting the future, and we don't know. We're grabbing ranges of possibilities. So I agree with Anthony, but I would say let's keep a look for what a winter looks like post-COVID on immune systems and on this country. And if wage increases and all this excess capital outpaces prices, right? Those two things and thematics can have an effect on the market we can take advantage of in the future. So I'll leave it there.
So I guess the thing is, and you kind of hit it on the head, Q, to get it started. Talk about portfolio management. Now, of course, we're going to be going into this a little bit deeper, so I'm going to let you take a swig of water. But so it's like we're going to talk about portfolio management for a hot second, because as we move in from, like, we're now going from Q2 to, let's say, Q4, you know, what should people be looking at? Like, outside of the economic data, like, where else should they be looking, Anthony?
Well, you know, I mean, yeah, the economic data is incredibly important. But I think, you know, anytime, well, first off, let's take a step back. You know, when I think about portfolio management, the most important thing, particularly for individual investors, is diversification, right? I mean, it's very, very simple. It's just not putting all your eggs in one basket, right? I mean, if you want to play individual stocks, that's perfectly fine, but you don't play one. You know, you play several of them, or you buy mutual funds, you know, or you buy ETFs. You just want to have diversification. You don't want to put all your eggs in one basket. And if you are, you know, diversified, but you do want to look at individual stocks, then, you know, it's a lot of things I talked about last time, right? It's coming up with an investment thesis that you really believe in, right? It's thinking about, you know, valuation. It's looking at the stock price chart. You know, where's the stock versus, you know, its 52-week high? Where's the valuation relative to historical levels? Where's, you know, sentiment? And if you do that work, you know, and you're diversified, you know, I think that's the way, you know, to quite frankly, to not only make money, but also like sleep better at night, right? I mean, you know, so I really think, you know, and by the way, that works in pretty much any market. It doesn't matter if the market's, you know, trading sideways, going up, going down. You know, you're going to do better over large periods of times if you are diversified and if you are, you know, doing the work and coming up with investment theses that make sense to you. Not, oh, you know, Elon Musk tweeted this, so I have to buy a Dogecoin or whatever. Or I saw this on Wall Street Bets. Like, I did the work, and that's why I want to buy Dollar General or Best Buy, or, you know, or you know, whatever the case may be.
Can I put some sauce on that?
Of course.
Go ahead, Q.
I think, you know, the dope part, right? So like a real life example of what he's saying, right? I think sometimes as investors, we don't look at the correlation between things, right? So like when you're looking at a name, there's usually a correlation to that name as far as whether it is an opposite trade or a correlation that runs alongside of it. So first off, I want to say shout out to my man, Sean Crenshaw, and Ovation Fragrances, right? Everybody knows I'm a fragrance head. I'll give you guys a quick example, right? So I got to throw some sprays in the air though one time.
Hey.
And okay, now we got a question. So if I'm an investor, right, and everybody knows, and if you know me and we had combos, I'm big on Estee Lauder. I'm big on Ulta for the reopen. And I'll say Ulta over Estee Lauder, right? And this is not financial research advice. Do your own homework, all that good stuff. I like Ulta. Why? Right? Internet margins never go up. It's a company that doesn't spend a lot of revenue on marketing or advertising, and has a great e-commerce business that was hyped up or piped up by COVID. And then on top of that, they have a good brick and mortar business, and they're able to take advantage of some things that their competitors aren't, right? But I bring up fragrances, right? Because that's a part of what they do. And so if I start to look at correlation trades, names like IFF, right? Names like IPAR, right? That are correlated to that name. So if I look at IFF, for example, I say, hey, I enjoy fragrances. What is that? It's international flavors and fragrances. What do they do? Well, they make food. They make healthcare items. So now I'm getting access to other sectors. Now I'm getting access to fragrance, right? And some of the things they do is they sell fragrances to businesses. So now they're making the baseline fragrances. So now I have a correlation trade possibly if I do enough research and I feel comfortable in the name. I can add some extra sauce to my Ulta trade by taking advantage in an area that also gives me diversification, because not only is IFF in foods, they're in fragrance, which is consumer staples, but they're also in healthcare. So I'm getting a multitude of names in two trades, right? In a recovering economy where people will have more money to spend on what? On health, on food, and on smelling good, right? And that's Quentin Martin, and that's been my time. Shout out to Sean Crenshaw and those businesses.
So, Quentin, I don't know if you're aware of this, but you just kind of trolled me because
I was gonna say, hey,
I cover Ulta.
he covers it.
I don't have a buy rating on it. Okay, I have a hold rating on it. So so thanks for that. Thanks for that. Thanks for looking out.
Hold on. I knew that this was gonna happen.
No, but like
what it's gonna start now. You know what we did here, right, Jolene?
I know what's gonna happen. Listen, and that's the great part about investing, right? Iron sharpens iron. Like it doesn't mean that I think it's going to the moon, right? I have my reasons for liking it. Anthony has a reason for having a hold on it. But the great part is that I can hear him out and say, okay, let me see what his thought process is on. I can tell him my thought process. We both walk away. We might both still feel the same. Or I might say, you know what? I agree with what he's saying. Maybe I have to reshuffle the name right for me, right? And that's the best part about investing. I think we get away from that part. We get into a money chase. We don't get into a knowledge chase, right? Yeah. I'm always here for the smoke because I'm here for the knowledge. I'm here to learn. I'm here to grow. So I can't grow if I'm not tested. See, like you can't go through life and not be tested because then you don't know where you're at. What grade are you at? Are you in college? Like you have to pass these tests. So I'm here for the smoke. Anthony's my guy. That's my brother. I know he has a whole rating, a little bit of a troll. I brought it out for him, right? Talk about that's my guy. I know he's going to teach me something. I'm going to walk away from the conversation.
Let's do it. We are activated. Anthony, can you please explain the whole thing, please, for the people?
Look, he got a little shady, so I had to put the shades on. Okay, so I mean,
my guy, man.
Had to do it.
Guy, man. That's that guy. Anthony's a brilliant mind, man, and it's just great to sit amongst other brilliant minds and be able to be in the room and be in the conversation. Like it's not about who's right or wrong. It's about learning. And I think that's when, as an investor, when you get away from worrying about whether you're right or wrong, or whether what's going to look like if you change your mind, or if somebody has a better thesis than you on something, it's not about that. It's about learning. What can I learn from the conversation? Because if I'm going to pour into you, you have to pour back into me. It's not a one-way cup. And so I think we have to get out of that mindset. And when we do, I think we start to have better conversations, lead to better investments. I think a lot of people didn't have great conversations coming into a year. A lot of people had one-sided conversations coming into a year, and now they have one-sided portfolios. And now they're feeling the heat because the market's not one-sided. The market is going to go and do what the market's going to do. And so you have to have multiple sides and multiple facets and multiple conversations and multiple opinions. If me and Anthony had the same opinion on everything, we wouldn't get smarter. Just wouldn't.
That's a fact. Like it's so cool, like in the sense of, I guess, to honor, especially Black Wall Street and especially where we're going with this Q. And, like rethinking like what Black Wall Street was back in the early 1920s. And here we are 100 years later. How can we do this so much better and preserve, but also at the same token build and be innovative as it pertains to like setting the new stage of what Black Wall Street can be. Like, I definitely want to know what your thoughts are, Anthony.
And that thoughts on that too, Anthony. So
yeah, I mean, look, I have to be honest with you. It starts right here. It starts with what you guys are doing, okay? And I have to be honest with you. Like, I remember Quentin first, telling me, hey, I know this guy, Mark, he's got this show on YouTube. I'd love to have you on it. Like, I had never heard of the Come Up series. I had never heard of Mark Monroe. I never heard of Jolene. It's like, I just didn't know. But I went on YouTube and I was like, wow, like, this is great. What these guys are doing is great. I think that, to some extent, yeah, we have to do it. It's on us. We have to do it ourselves. No one's going to, is going to do it for us. And so, this is the way that it starts. And it starts, with what a lot of the cousins are doing, right? I mean, dipping their toe into the market. And look, you're going to make mistakes. Like, that's fine, but you're learning. You're going to learn from those mistakes. And quite frankly, like I said, if you're just continue to put money in the market, it's going to grow. And as you educate, the next generation, and then they educate the next generation after them, we are going to close this gap. So just keep doing what you guys are doing. And I know, I know there are other people that are doing it too. And it's wonderful. It's really, really wonderful. So just keep doing what you're doing. And understand, I think we all need to understand, this isn't going to happen overnight. It's not a bunch of us are going to buy GameStop at 200 and it's going to go to 1,000 and we're all going to retire and we're all going to be rich. It's, there are no shortcuts. Let's do the work. Let's get smart. Let's learn every day. Let's teach each other. Let's learn from each other. Let's get it done.
I agree. Q, any thoughts?
Oh no, I want to let Jolene get her bars off. I'm here.
Go ahead, Jolene. Rock the mic.
Right. So within the context of wealth building and all this, I've been writing and I've been thinking about just different things. And one of the things that I have been focusing on is, as you know, First Lady of Leisure. So I have been focusing on what leisure really means, because a lot of people have it messed up. They think it's about lounging around or like not doing anything. But when I think about the word leisure in the context of like rebuilding Black Wall Street, like I always say, our ancestors labored enough. We're done with that. And the whole notion of leisure really has to do with being able to control and create income out of thin air. That's what it's about. So when we are thinking about the leisure, the ability to contribute your gifts and talents freely without having to clock in, because if you're clocking in, you don't control or create your income, someone else does. And on Black Wall Street, there was a lot of creation and control. That's all it was, period. And so this other missing piece really is about being able to create and control your income. And as we all know, Black people are one of the most innovative and creative people. If we set the trend, we set the tone, period. Don't argue with me about that. Don't come at me about something opposite to what I just said. Because when we do something, people pay attention.
Yep.
That's just how it is. The problem is that we don't get money from that. None of that has been able to convert to cash. And so what we have here, we have cousins that have over leveraged themselves. And when they're thinking about wealth building and thinking about generational wealth, the focus is on the market. That's one piece of it. There's this other piece when we get to learn how to, and I don't like to use this word, but I'm going to use it for lack of a better phrase. We get to learn how to master the ability to control and create our own income. So part of that, whenever I say, it's a heist in the market, part of that is taking that money out and being able to reposition it outside of the market too. You can't just have everything in the market. I mean, Mark, that as a VC, you're invested in a whole bunch of different startups. And so if we can
12 more days left. By the way, 12 more days.
Well, we can get to a point where we are aware of what those gifts and talents are. And we're aware of our value. We talk about knowing what your value is all the time.
Yep.
We have people that don't know what their value is. And so when you know who you are and what your value is, you're not going to fall for the okie doke on meme stocks. You're not going to be gambling because you're too valuable and you're too precious. This means too much to you to risk it all on some, something that is here for a moment. We're talking about longevity. Black Wall Street, the fact that there were multiple Black Wall Street should say something. The fact that there were multiple Black business owners that actually had brick and mortar businesses to have a context for circulating that dollar. What's happening is that we're putting our money in a market that we were once traded on. And so now we're trying to figure out like, okay, now how do we maneuver? How do we manage in all this? And it's like, this is the time to take those lessons. This is the time to really be real with yourself. If you're a trader, you're a trader. If you're a gambler, you're a gambler. If you're going to be an investor, then be an investor. Whatever it is, be able to stand on your own 10 toes and not come at somebody else thinking that, that person owes you something. That mentality, that goes back to the worker mentality. We're not on that. And so I don't know what it's going to take to make that shift, but we need to start thinking about that as well, because otherwise we'll just keep spinning our wheels and then we'll have cousins, talking sideways, talking greasy. I see every single comment that some of y'all make. And it's to the point where it's like, yo, okay, let's stop. Let's take responsibility. Be honest with yourself. You know, you were putting money in the market and you couldn't afford it. Point blank, period. You couldn't afford it. There's probably some other things in your house that you couldn't afford. And we just got to get to this point where we can be real with one another and with ourselves, with your portfolio, and get to this place and space where you are starting to learn how to control and create your own income. Because if you don't do that, congratulations, you played yourself.
All first verse. May the church say amen.
Amen. I say it all day.
So I guess the biggest thing for me that I was thinking about was it first starts off with racial wealth gap. And so looking at that, it's like, you know, we got to get to this point where the racial wealth gap is not just in the sense of dollars. Mm-hmm. You know, that's one of the main things that why the Come Up series is so like important, and many other platforms like it, or, you know, them, and also platforms that may be different. This is the reason why it's important, because it's not just about dollars. Racial wealth gap also gets solved by the mind as well. Like when you have the tools, when you have the knowledge becomes tools for you to ultimately be able to say, okay, hey, like what Jolene says, go out there and create. Go out there and do things. Go out there and start a company. Go out there and, you know, invest in a company, whatever it may be. If it may even be real estate, if that's your thing, then do it. Because then at that point in time, it's like the knowledge in which that you've gained is now a tool in which that you can now create the wealth in which that you would like to build. And alongside, essentially, the dollars ultimately tend to follow. Now, the thing that we always have to ask ourselves, and after this, I'm going to move it on to Anthony, because I want you to like definitely have a mic drop, and I definitely want you to give the benediction tonight. So I want you to just like think about, because I know you're going to come in hot. So, but the thing is like, you know, really, it really starts with the mind. You know, train the mind, the body will follow. Like, gather the knowledge, and ultimately everything else will fall into place. Will you make mistakes along the way, like Jolene says? Yes, we all have. You know, that's a part of the process. That's a part of the learning. We fall, but at the same token, we get right back up. That's actually been one of our strongest suits, which makes us so rich of a culture, which makes us so strong of a culture.
We're resilient.
I mean, think about it.
Can I get my
you're talking about a history of terror and trauma, and yet we're still here, and we're not just still here, we're in the process of thriving. So just think about that. Like the racial wealth gap goes well beyond money, but it also is about here. This is really where the real battlefield really starts. You solve and win this war up here. Everything else is simple.
Yo, Mark, can I get my bag real quick? I got a Jolene, like, you know, it's in my spirit real quick. I just want to say,
whoa,
touch on, you know what I mean? I gotta say something. I think people don't understand this, and quickly understand this. When I always say, like, what's your name worth? Everybody wants generational wealth, but nobody wants to tend to the soil. Your name value is not necessarily built on how much money you have, it's built on the character and the knowledge you have.
Yep.
Right. And so at the end of the day, I know some people that may live in the Trump building, and they lived there probably prior to the presidency and everything else, right? They're embarrassed to tell people what building they live in. Now, he doesn't own the building. Maybe somebody bought the name rights, whatever. They're embarrassed to tell people the name of the building. The building's still nice, right? Amenities, views, everything. They're embarrassed of the name, right? Because you can ruin your name. It don't matter how much money you have.
That's
your
correct.
name and your legacy is built on your knowledge, your character, how you treat people, how you carry yourself. So when you get in the market and you start chasing money and you make bad trades and you start chasing the fallacy of material items, and I want this and I want to flex, and now you're in a situation where you shouldn't be because you made decisions, ain't nobody else's fault but yours, dog. Ain't nobody else's fault. Nobody made you press that button. You press that button. You have to ask yourself every time you press that button, why am I pressing this button? When I make a trade, I'm asking myself, what is the premise of this trade? Why am I in here pressing this button? I should be doing work or something else. But at the end of the day, it's not built It's not built on how much money I have in my account. It's built on who I am as a person. And I'm the same person everywhere I go, whether it's the internet, whether it's the boardroom, whether it's chilling with y'all. Ain't nobody can tell you it's a different Q. I'm the same goofball because my legacy matters. My name matters. When I'm not here no more, I want cats to be able to talk freely and that was a cool dude. You know what the best feeling is when people that don't know each other, they meet each other, say, hey, I met so-and-so and we talked about you. That conversation is either really good
or really bad.
based on how you carry yourself as a person. And at that moment, it don't matter if you got $1 or $1 million. That conversation is built on how you made them individuals feel and who you are. Be accountable for who you are. I'm not accountable for you. When I wake up, I'm Quentin Martin. It's free to be me. I'm not going to be nobody else. There's a lot of people who play wrestling and acting. I don't do all that because my legacy matters. When I'm not here no more, they're going to talk about me, and everything they talk about is going to be real because I'm real. I'm going to leave it right there.
All right. Mr. Chukumba.
Yes. Tonight.
The stage is yours. If you were to leave anything behind as it pertains to knowledge, hit us with it.
Yeah, I mean, look, I think we've had a great conversation. I'm a sell-side equity research analyst, so I talk about stocks. I have ideas, and I'd love to, just quickly talk about them. So the last time that I was on here, I had 2 long ideas. Specifically Best Buy, ticker symbol BBY, Dollar General, ticker symbol DG. They're both down a little bit from when I was here last. I like them even more at these levels. Both companies reported first quarter results just last week, actually. In both cases, they beat consensus numbers by a country mile. They also raised their guidance for the remainder of this year. I think that, basically there's sort of this like anti-reopening trade, right? Like, in other words, well, Dollar General did really well last year because, everybody was cooped up in their houses and all these stores closed, and, they were able to keep their stores open, and everybody was, essentially hoarding toilet paper, and they benefited from that. And they're going to be anniversarying that this year. Okay, that's all true, but here's the thing. They have a lot of company-specific initiatives that are in the very early innings, like self-distribution of fresh and frozen items, which has a huge gross margin benefit from them. They're doing a much better job of selling discretionary merchandise. That is a much more higher margin for them. They're buying back a ton of stock. They're definitely going to benefit from that child tax credit that I talked about. So, when you start to peel the onion, there's a lot more there. And so I think that they're going to be able to comp the comp. Same thing with Best Buy. Once again, everybody's like, well, last year, everybody had to work
Curbside pickup,
do school from home. Everybody bought a PC. And once again, they're going to have these really, really tough compares. But here's the thing, people are starting to go back to work, but they're not going back to work 5 days a week. It's a hybrid environment. To some ways, that's going to be better for Best Buy, right? Because now I need to have 2 PCs. I need to have a PC in the office. I need to have a PC at home. And someone's going to be taking that PC from the office, from home into the office. And guess what? Sometimes I'm going to leave it on the train. Sometimes it's going to fall out of the cab or whatever. It's going to break. I'm going to need another one, right? In addition to that, we're very, very early in a new video game console cycle. Very early. They're really, really good at selling hardware. In addition to that, as I talked about last time, one of their largest sort of regional competitors, Fry's, went out of business. They're definitely going to pick up market share from that. In addition to that, they're going to buy back a boatload of stock this year, just like Dollar General is. Both of them actually pay a dividend. And so I still like both of those stocks. In terms of, I believe that Quentin called it kick it to the curb. This time I'm going to go with a different name. And it's actually related. It's Dollar Tree, ticker symbol DLTR. So basically Dollar Tree has 2 concepts: the Dollar Tree concept, where basically everything's $1, and then the Family Dollar concept. They bought Family Dollar, I think 6-7 years ago at this point. It's been an absolute positive disaster. They cannot successfully operate a multi-price point retailer, which is what Family Dollar is, as opposed to the core Dollar Tree concept. In addition to that, it's become very, very clear that all their struggles, these multi-year struggles with Family Dollar, have forced them to take their eye off the ball in terms of the Dollar Tree concept. So they reported earnings last week as well. The numbers were good for the first quarter, but they basically said they're going to have like 70 to 80 cents of incremental freight costs for the remaining quarters of this year. I mean, look, we know that freight is more expensive, but I cover a lot of retailers and nobody else was saying, oh, by the way, here's another, incremental 70, 80 cents a quarter of freight costs that we didn't know about 3 months ago. So they've really become the gang that can't shoot straight. Kick them to the curb. So, like I said, we like Best Buy, we like Dollar General, we would kick Dollar Tree to the curb. I'm out.
Now it's interesting, a lot of those companies in which that, they did pretty well in 2020. What would be some of what would you say would be some of those bear cases in which that you're hearing about some of those? Like, for example, like Best Buy and let's say Dollar Tree.
Yeah, look, I think I've seen this a million times. I mean, sometimes these investment theses, these bear investment theses, they're just very sort of surface level, and in both cases, it's very, very simple. Well, as I said, people are getting vaccinated now. So they're going to start going back to restaurants. They're going to start going back to sporting events. They're going to start going on vacation. They're going to do those things. So it's going to be the spend diversion, right? And I don't disagree with that. I don't disagree with that at all. But you have to really look at each company individually, and you have to kind of figure out, is that spend diversion really going to impact them, the way that the market's pricing it in? And with a company like, for example, Dollar General, I mean, 75% of what they sell is consumables. We're talking food, we're talking, cleaning products. I mean, it's like, yeah, what if you go on vacation, you're no longer to buy toilet paper? Like, no, that's not how it works. And even with Best Buy, like I said, I mean, it's like, we're going to be going back to work in this kind of hybrid type situation, and there's all these other very company specific things. So it's like you have to do the work. You can't just have this very simple investment thesis. When I've made mistakes in terms of picking stocks, it's almost always that my investment thesis, it's not just that it's wrong, it's also just way too simple.
On that note, Anthony, you are officially off the hot seat. Thank you, Anthony. You have this is the first time that we've actually ever had a part two.
Wow, I am honored. I am honored. I also find that inexplicable, but I'm honored.
I mean, it's super duper cool because of the fact that, one, it's like we get to have this conversation about the market as well as talk about it from the analyst side of things as well as the research side. But then the cool part is that, just think about the thesis in which that everybody's going to go back and say, all right, now it's time to dissect the thesis of looking at Best Buy, looking at Dollar General or Dollar Tree, and then also looking at some of the other players in the space alongside of those to see how is it that they coincide. So it's going to be very, very interesting. And also to see exactly how these companies play out over the next 6 to 12 months for sure. So thank you once again. I know from us at the Come Up series, we truly, truly appreciate you just spending the time with us. And anytime that you want to come back and be, on the show and talk about some of your most recent upgrades or your downgrades or just your most recent ratings, you are more than free and more than welcome. And we would actually love to actually have sessions with you if that's possible. Maybe even, more regularly if that's something that you're interested into, where we can actually start discussing and going through the whole thesis of some of the things in which that you're researching, so that way we can learn further. Is that okay?
That sounds wonderful.
That's dope.
All right.
We're already requesting a part 3, so I'm just
wait for real. We just did a part 2 and now they want a part 3.
Listen,
here's the problem with part 3. Okay, Godfather amazing, Godfather 2 amazing, Godfather 3 trash. Okay, so we be careful what you wish for. You just might get it.
I look at it more like the Fast and the Furious, like 11 movies. You know what I mean? It's got to keep on going.
Oh Lord, are we Transformers?
Yeah, but by what? 7 or 8, they were racing against submarines. Come on, man. I can't. I'm not going to jump the shark. I'm not jumping the shark.
That's called innovation. That's called innovation. That's all. It's innovation.
Well, I like the idea of the research. Coming through and helping the cousins not have the simple thesis as you described.
Yes.
Happy to do it.
Speaking of which, Q, when can we get another Walkaway Wednesday?
I mean, summertime's looking all right. My schedule's starting to, open up. Where's my man Chris Bush at, man? Somebody put the bat signal off for Chris Bush, man. And let him out here.
Chris Bush, you heard it. Go ahead. Make the call. All right, y'all. We're gonna let these gentlemen go home and get some rest, or they're already at home, but just let them rest. Q, you know what the vibe is. Thank you so much for joining us. Anthony, always welcome, always a pleasure. Love to have you stop by more often so that way we can talk about ratings and research. So always welcome, just let us know. Jolene, you're amazing. Until next time, I am Mark Monroe. Feel free.
Well, I'll say I'm the big cousin Q.
I am not the keeping it kind cousin. I'm still the keeping it real cousin. Deal with it. Deal with it. Real talk.
That's hilarious. And I'm Jolene GC in the place to be.
And this was a come up, aka the Cookout Part 2. We'll see you in the next one. We'll see y'all next week. Have a great weekend. Be kind. Keep researching. The more you learn, the more you